We're joined by a panel of operators and institutional investors. So excited to hear the various perspectives about this. We want to start by just introducing yourselves.
Business at PIMCO, which covers many different things beyond real estate, including digital infrastructure.
Matt Harris, I'm the CFO at K-Data. We have 4 sites across the UK and a pipeline in Europe. We've got about 100 megawatts, so I guess that makes us scale up in this environment.
So we're Vicente Vento, I'm the founder and CEO of DTCP. We're an investment management company focusing on digital infrastructure and growth equity, and we have about 3 billion euros under management and about 10 investments into fiber networks, data centers, and tower companies, primarily in Europe.
Cool. And my name is Michael Gord. I'm a serial entrepreneur investor focused on digital asset investments, pre-seed to Series A. Few investments in this niche, but primarily Web3. But panel is primarily about these guys, so let's jump into it. Before the panel, I was having a conversation with Matt about how seed stage investments today in digital infrastructure are quite a bit different from how we are, at least in venture capital, are often seeing seed stage investments quite a bit larger and quite a bit also more capital that's needed for all this stuff. So maybe let's just start off by talking about how investments let's start off by defining what digital infrastructure is for each one of you guys, so that we're thinking about it the same.
Yes, sure. So obviously, traditionally, digital infrastructure, towers, fiber, obviously data centers as well. If I were to attempt to put a perimeter around that, and it's a bit of a movable feast, I think it's been really interesting the way there's been so much talk about GPU as a service. CoreWeaver, a company that have come up a lot, even in the conversations of institutional investors who may be relatively recent in the data center space. So I think I'd definitely expand the parameter of digital infrastructure to include that type of infrastructure. I think there's an interesting argument about as you start to abstract the infrastructure from the business, to what extent does something stay as digital infrastructure. We're a data center operator. If you're in Slough, you probably lease from Sagro and don't own your building, you're still digital infrastructure. If you're a virtual fiber network, are you still digital infrastructure? Probably. But I think that if I were to draw the line around that, I'd put it around this sort of emerging GPU as a service. I think I'd probably stop short of some of the Web 3.0 type activity, which I know you're very familiar with, and you may want to counter me on that, but I still believe there needs to be an element of physical assets, but that dynamic is moving such that it can be relatively short-life GPU type infrastructure and not just 50-year buildings.
Makes sense. I think we differentiate between the real asset piece, which is sort of our flagship strategy, where we, independently of the stage at which we invest, we want to have physical ownership of the assets or very long-term leases on the assets. And I would say in terms of some of the adjacencies to the traditional fiber models or tower models or data centers, I think that this has expanded into things like small cells, DAS, various forms of fiber, so from FTTH to fiber to the tower to long transport fiber to submarine cable. So I think that the industry has gotten a bit more complex over the last decade or so. I think the same story for data centers. I think we've talked a lot about hyperscale deployments, but obviously there's edge, for instance, which is an interesting sort of incipient category. There is also traditional colo data centers. There is governmental data centers which have some other forms of requirements. So I think we would characterize all of that as infrastructure. And then something we do with our other fund strategy, our other team, is infrastructure software. And so those are effectively the tools tools that you overlay on top of those physical assets that really help drive traffic and steer traffic and lower latency and ultimately provide the sort of services that the customers require. I come out of a past in telecoms, and that's also a very important part of that supply chain, of the integral or vertical telco stack to have a solid base of infrastructure software on top of the real assets. So that's how we have kind of split a bit our focus, and I think in terms of the real assets part of it, certainly we are looking for long-term contracts as a key defining element in our underwriting. We're looking for elements like inflation protection, which I think in the last couple of years has been particularly important, and so we would include that in the definition of digital infrastructure.
Yeah, maybe kind of from our perspective, I think we're probably closer to you in the definition of the digital infrastructure for us. But for us, the key thing is that the strategies need to be asset heavy. So it's difficult for us to define something that is infrastructure and is asset light. So for example, on the lease model, things like that. And then the second element is around the volatility of the cash flow. Obviously, compounding at the inflation rate is important, but ultimately, like how much variance do you have around the range of outcome, which naturally lends either to mission critical facilities or the facilities that end up being on longer term contracts as a result. But in all cases, these are asset heavy businesses that we get exposure to.
Cool. I like the thesis. So to summarize, digital infrastructure is the hardware and the software used for digital infrastructure. Kirill, just to dive in, I wonder, with regards to asset heavy, are you referring to like the real estate or the chips or both?
No, it is more around either real estate related stuff. So, for example, you can argue that data centers fall pretty close in that respect, but it's also fiber and towers, right? So which is again pretty asset heavy businesses. When we talk about, we have a separate strategy that involves investing into chips, but it sits outside of digital infrastructure and more in the specialty finance business, just given the expected life of the investment, which tend to be quite different from longer term asset heavy businesses like data centers, for example.
Cool. Let's talk about the progression of the industry, because it has been growing really fast since digital infrastructure started at the beginning of the internet. With some of the individuals I met here were creating data centers before AI, before robotics, and the hardware. And I guess that also would, and then fiber optics became a thing. Let's talk about how investment theses have changed over the years and up until now. Let's talk about just how the market has developed over the past 3 decades.
In what way?
Just I want to talk about trends and opportunities next, but let's maybe go back, and because from my perspective, it has been going fast, but I feel we're at an inception point now that is making it, that is tipping the trend from an already fast growing trend to an exponential trend. So I want to dive into or talk about what led the industry to get to the point where now we've reached this tipping point, or challenge me if you think that we're not. I'm also happy to be corrected.
Well, I think everything seems quite quick in the infrastructure world. I first came into data centers from more of a venture capital, investing family office capital in venture capital businesses. And you can see whole product cycles come and go in 18 months, but there is a physical reality, as Kirill was saying, to the digital infrastructure, which means everything takes a while. So we were deploying NVIDIA DGX SuperPods back in 2020. So now in 2023, generative AI as it really starts to find its use case, but actually it's building on quite a lot of technologies that have been there and being developed for quite a few years previously.
I think maybe if I may sort of redirect your question a little bit, I think what's quite interesting and was somewhat touched upon in the past panel and the prior panel is the software side is incredibly fast, right? So, you know, ChatGPT getting to 100 million users in a matter of, I don't know, months, right? Like, that is really sort of putting a lot of stress in the system, because obviously that software, those applications have to be hosted somewhere. And we're just starting to see the tip of the iceberg. Now we're going to get into all of that, you know, those LLMs basically getting native into a myriad of enterprise and consumer applications. Everything the same way it's cloud is going to be AI. So tremendous amount of demand. And as he was just saying, right, it takes you, give or take, 2 years to build a data set. So, you know, you can do whatever you want, but between the point in time when you locate the land and the power and, you know, get all the contractor ecosystem in place, et cetera, takes a long time. And so we are talking right now about capacity that we already know we're going to need, and we're going to spend probably as an industry the next 4 or 5 years really building it. And I think that delta establishes sort of that tension, right, between the dream and, you know, what we all think might happen, and then how the market catches up with that. And I think that, you know, it's super important for what you call seed or greenfield capital to, you know, have as good of a perspective of that as possible, because it's easy to overshoot. And I think this industry in particular has a good or a bad track record in overshooting, right? So we saw it 20 years ago when everybody was building fiber lines on the back of the dot-com bubble. You know, too much fiber was built, and we spent a decade effectively trying to absorb some of that capacity. We've seen it with submarine cables, where, you know, too much capacity was built and then the pricing was destroyed. So I think that there is a real risk that, you know, people who are now extremely excited about what I believe is, you know, transformational technology, and I think everybody agrees, but that we are underestimating things like the path of technology evolution and efficiency, and the efficiency of chips and GPUs going forward. And, you know, obviously we're quoting now 50, 60, 100 gigawatts of capacity required, and the power limitations, and everybody's building solar and wind, etc. Let's all be sort of a little bit cautious about that, right? So let's try to you know, keep our feet on the ground and not create a situation of massive overcapacity.
Yeah, interesting, because I'm primarily sitting on the software side, so I am considering that there's been decades of growth leading up to this now exponential curve on the software side, but the software growth does lag behind the capacity, the hardware capacity. So interesting thesis. You spoke about ChatGPT, and which I think is the fastest company to grow to 100 million users ever. There's also, we brought up, CoreWeave was brought up, which just raised $7.5 billion as kind of seed stage scale up company. They were far from that size 3 years ago. And there's some others. X.AI is raising billions. New company, their first, I would say, seed stage investment is raising, I forget the terms, but something like $1 billion at a $10+ billion valuation. How is this digestible? How are companies like CoreWeave, X, a little bit different, Twitter, but even with X, how is a new company coming to market? It's with seed stage rounds of billions of dollars.
I think it's a really interesting dynamic. I was very struck by what one of the panelists said in the previous panel, in terms of noting that data centers have moved very quickly and having what I might construe as a relatively conservative approach, and then immediately noting that they'd also been participatory through another arm of the business within the CoreWeave raise, which is then much more of the more sort of technologically risky end of the spectrum. So I think it is interesting and possibly a little bit surprising the way that some of these new companies are able to raise from those very deep pools of capital so early on. And I think one of the challenges that gives for more seed or VC type capital is it just really close the window. It does potentially make the wins very, very big, and the IRR is exceptional because you can turn the businesses around so quickly. But the window in which institutional capital is coming in is very quick. I think there's a little bit about edge data centers as well. I'm not sure, again, from listening to the panelists over the course of today, that they've necessarily really found their use case. But there is still considerable institutional capital funding that build out and that development in anticipation of that use case coming. So it is unusual, I think, in our sector the way that institutional capital is moving quite a risk-on phase of the technology.
Let me try to segment between software, where you're coming sort of very strongly from, and sort of real assets, right? So, and try to draw some parallelisms between the two. I think in software, it's all about the market opportunity, right? And so when people are looking at newly established businesses, they look at the team and the track record, and how big is this opportunity? And so we're seeing, I think it is true that in the context of AI, because everybody recognizes it's such a transformational technology, and everything is going to be sort of redefined and redesigned, that a lot of people are putting a lot of very high hopes on companies coming up, and if there's a team that has sort of real credibility in a particular area, those valuations tend to be very, very high from the start, right? And we are seeing seed rounds at $1 billion in Silicon Valley from teams that are doing AI applied to robotics, and they want to revolutionize manufacturing, and these kind of things that are really sort of we saw a company recently called Grok, which is now a chip that's basically incepted or thought for LLMs, as opposed to taking a GPU, which is just a coincidence of life that there was a company called NVIDIA that was doing graphics cards, and now this is now used for AI. So, and these companies are high potential. I would say they will require quite a lot of capital, but not at the same rate that a real asset infrastructure company. And you have to be careful with what you're underwriting, and probably 100 of them will fail, and one will become a $100 billion market cap company, and that's effectively what venture capitalists are underwriting. I think if we move to real assets, what I like about the real assets is that even if you are backing an early stage team, you're typically have some things in place, right? So data center platform is a good example. When you have a team that's done it before, and they know how to sell and how to design and how to build. When you have the land where these data centers are going into, you have the power secured, and ideally, obviously, we're all looking for that contract with hyperscaler, etc. That in itself is a valuable business right out of the gate, and I think there's a fairly easy way of pricing it, depending on whether you're doing 50 megawatts or 100 megawatts or 20 megawatts. And so from that perspective, it's not inconceivable that these businesses are hitting that mark. If you have a contract for 100 megawatt from AWS, yes, your business is probably worth €1 billion in today's world, right? So that's effectively a completely different risk proposition. So just to sort of make that distinction between one world and the other world.
Yeah, maybe I'll add so slightly different perspective on this. So there is obviously one thing is to what extent the company that you're backing has some form of edge, right? And to your point, if they manage to assemble a great team with a very strong talent in a very scalable opportunity, and they have a unique feature that you cannot find anywhere else, it's very easy to make the case. The other way to make the case for a scalable investment is to what extent it complements the capability of the investor, because the investor itself can add a lot of value to the business by bringing in other verticals within its broader platform. But coming back to the original question, like how can companies manage to attract so much capital? With digital infrastructure panel, I mean, in a world where there is quite a bit of uncertainty, very often putting the word infrastructure somehow make it into an investment that is perceived to be less risky. And with digital, it looks a little bit more of a secular nature, so that naturally kind of allows some investors to shift their focus out of more traditional asset classes that are maybe underperforming, where the outlook is very cyclical, maybe even downward. So it's just the nature of the capital flows that, in an uncertain environment, they need to move somewhere, and they either move into something that's more of a fixed income. But for people who are a little bit more excited, can get a little bit more excited and move into infrastructure-like investing, because that gives that sense of protection, even though, even at the earlier stage investments, they are still very risky ventures, but in a sector that maybe perceived as somewhat less risky.
So Carl, from your seat with PIMCO, obviously institutional investor, lots of AUM, and getting into some let's say early stage but digital infrastructure investments, but with large tickets. How do you structure a deal in a way? And with software, it's a little bit different, as we've been talking about, because OpenAI is burning hundreds of millions of dollars a month just on their data centers, on their LLM models. So they actually, I think, have a significant need for capital, or a significant need to ensure they have the runway to continue to develop this and to compete with the Googles and the X's that are looking to do a similar thing. I think with hardware, because there's less immediate, you need to, let's say, know that you have access to a sum of capital, but you need to first do the construction, then you need to, it's not all at once, right? There can be milestones that unlock capital. I wonder how you would think about constructing a deal that de-risks a large principal investment. I wonder how you would think about structuring a deal.
Yeah, so, I mean, in an ideal world, everything is already in place. You have the team, you have some form of a seed asset, and that asset may be somewhat de-risked. That's a perfect deal, because then, you put in capital, it's instantly, if you go and develop that asset, it will be profitable, and you just create additional upside from it. The world is very often not ideal, and you need to start somewhere, and the most important thing that you start with is the team, right? The good thing about asset-heavy businesses is that the cost of running the team, or having the team in place, very often is relatively small compared to the return that you would get once you have made your initial investment, let's say in a data center, right? Because once you made that investment, and suppose you have a contract with a hyperscaler, it pays off very quickly. So you can afford to have that drag, let's say, to your return from having the team in place for a while, but that drag somehow impacts the ultimate shareholding that the team will have in the business. So the longer it takes them to take off, to launch the business, etc., into something realistic, the more dilutive the investment, the more diluted they eventually become. But ultimately, as long as you have conviction about the strength of the team, and conviction that there is some complementarity between the business that you're launching and the existing platform that you already have, you can straight away go and add value to it. So as a simple example, again, in a data center space, you set up a business, it's the business that focuses on development and operation of data centers. Great. What's the complementarity that we have? We have a huge real estate business that can go and find land and take it through planning and powering, that can accelerate that first phase of the development for the team, that the team wouldn't be able to do it on their own, just because they don't have 200 people on the ground looking for land all over the world. Right? which is so that's how we underwrite. We look at the quality of the team, but we also look at the complementarity within our business and how quickly can we help the business unlock its value.
Cool. I want to dive into this more, but we're running out of time, and I want to leave a chunk of time to talk about trends and opportunities in the future of digital infrastructure. So you guys want to just share your perspectives on what the trends and opportunities are and where you think the investment opportunities are today?
I can start, yeah. So trends, obviously, continuous rollout of AI, for sure. I think that the way we think about the ecosystem of digital infrastructure is that you will have, and I'm particularly focused in Europe, which is a good example of this notion that there are areas that are power constrained, and those areas tend to coincide with the centers of consumption. So, UK, Germany, Holland, France, etc., don't have a whole lot of excess power supply, while you have, in the south of Europe or in the north of Europe, quite a lot of either solar or hydro and wind power. And so for us, the way that we kind of look forward to the overarching sort of industrial layout of digital infrastructure is about the manufacturing sites of the future are these large format data centers, which are going to be located in secondary and tertiary markets. They're going to be close to those renewable power sources, and then there's going to be a ton of networks that are going to be required to bring the data to and from those data centers where the training is happening, with probably a smaller subset of data centers closer to the consumption where the inference will happen, etc. And then I think that ties very neatly into the use of mobile networks and densification, because ultimately, we all have to get the AI into these thin devices that don't have a lot of computing capacity, and therefore you need extremely dense networks, and you need a lot of towers or smaller sites, distributed antenna systems, etc., to ultimately get this into cars and get this into phones, etc. So I think that's how we're thinking about the opportunity, and accordingly deploying our capital against that vision of how this ecosystem builds up.
I think that's absolutely right, and as an operator, we are both looking at opportunities to increase capacity in existing data center hubs, so that we can take advantage of the inference opportunities. There is a school of thought that as you have, say, financial services companies, they may have a model trained in a very large remote data center, but when it comes to the inference, they want to process their existing data, which is often already in urban centers and major data center markets. So we are very much pursuing those sorts of opportunities in particularly sort of the next tier of markets down from the flat market, like markets like Berlin, Madrid, those sorts of markets, while simultaneously also looking at some very large sites with the opportunity to do the sort of large language model requirements of some of our customers. And what's been really helpful in this regard is the way that the financing has evolved so quickly as well. It's the point that another contributor on an earlier panel picked up, the way the data center industry has really sort of cycled through to the already at the stage of ABS markets and bond markets and private placements and all of these other options. So you definitely are seeing complexity in the way data centers are financed, particularly with the larger portfolios where they will be utilising a range of these different financing structures simultaneously to fund different parts of their business depending on what type of assets they are. I think ultimately what's quite interesting as well is that there's quite a lot of real estate money now seems to be seeing data centres more and more as core, and that's really quite a deep pool of capital that I think will be really helpful, particularly if the very large sites do become more prevalent, simply for the quantum of capital as previous contributors have mentioned that will be required to build out that capacity.
Yeah, and I mean, a lot of things were said, great thoughts on it, and I would agree with both. I think the only thing I would add is that probably the big theme at the moment is the scalability of the campuses in data centers, because like acquiring now a site that maybe has capacity for 20 megawatts is probably not that interesting, and that probably doesn't really future-proof it and doesn't unlock the full return profile. Acquiring sites that have more than 100 megawatts of capacity, that's where the real opportunity is at the moment. However, that's obviously the most difficult sites to find, particularly in the low latency locations, right? Of course, like finding something in Sweden and Norway is a little bit easier than finding something in Frankfurt, Berlin, or Milan, Madrid. So that's where the real alpha is. But kind of once you have identified those opportunities in markets that are less power constrained, but where you can have scalable capacity, that's where the most attractive profile of investments currently found.
Great, thank you.
Sorry, let me just add one final comment so that not everybody in this room starts building data centers. So, like 3 years ago, like everybody was like fiber to the home, right? So fiber to the home was like the trend. Everybody went into Germany, everybody went into the UK, and now we're seeing that there is a tremendous amount of overbuild, and people, are not getting any customers on their network. So, I think we shouldn't all start buying land with the hopes that we can build a data center on that. I think that we shouldn't start all platforms with the hope that hyperscaler is coming. So when we talk about trends and opportunities, some of that is also saying, hey, do I have the skills and capabilities to really develop these platforms? Do I have a team that has a track record to have done it before? Are these locations the right ones? If you are a strategic, you clearly have an advantage because you have existing relationships with your customers, right? So I just want to sort of put a little bit of cold water on this conversation because it is an exciting time, but we need to avoid what's happened to fiber, and we need to avoid what happened like 15 years ago with long haul transport, that we just create too much supply.
Yeah, please don't build data centers.
Exactly.
That's a to him.
Amazing. Vincent, Matt, Kirill, thank you very much for the amazing discussion. I'm just going to end it off also with two trends that I'm seeing in the software side. AI mining. There's existing data centers don't have the capacity from traditional hardware to build AI. There's going to be 40 million, according to Sam Altman from OpenAI, there's going to be 40 million homes worth of power that's created in the next 10 years. Powering AI, so AI mining, contributing computing power to the AI grid, I think super exciting, and then decentralized physical infrastructure, turning all hardware devices into a cybersecurity mesh network that can power also physical infrastructure. So two things I'm excited about. We've got enough time for one question, if anyone has any questions for the audience, or for the panelists. That's good.
Drinks.
Great, well.